been a challenging time in the markets of late, not least since the beginning of 2020. Menhaden, with its portfolio focus on quality, high conviction positions in both public and private markets, has weathered the recent storm and is well placed to benefit from both the shorter term return to normality and also the longer term structural shift in our attitude to environmental issues and demand for energy efficiency in all walks of life. I will now hand over to Ben and Luciano to speak in detail about the portfolio, performance, and their outlook for the future.
Thank you very much, Matthew, and thanks to the Frostro team for organising this. These webinars, I think, and marketing calls have been a boon during the last year, and we're delighted to be able to speak to so many people at once. I thought it might be useful to tell the story of how Menhaden came to be, and then we can delve into our investment approach and some of the larger positions in the portfolio. So I've focused my investing career on the theme of the green industrial revolution, if you like. The world is undergoing a profound shift in the direction of much greater efficiency of use when it comes to energy, water, raw materials, and waste. Renewables have taken off, electrified transport are hard on their heels. The kinds of things that were considered the preserve of tree huggers back in 2005, when I first started my previous business, Web, have become mainstream. Web is a listed equities fund manager with about £1 billion under management in a long-only, open-ended structure. I'm still a shareholder in Web. But in 2014, I stepped back from Web from a day-to-day perspective with the aim of creating Menhaden. And what I wanted to do was create a vehicle that could emulate the best characteristics of some of the permanent capital vehicles that are so famous in the London investing scene. RIT Capital, for example, Lord Rothschild's vehicle, or Caledonia, a foreign and colonial, British Imperial. Some of these family-backed investment trusts which have permanent capital and a multi-generational outlook. I'd been exposed since the start of my investing life to my own family's investment vehicle, which is a private, closed vehicle operated out of Switzerland. And I'd seen that having a really long-term approach was a huge advantage, rather than the sort of Damocles of funds being withdrawn from you the next day, or the time-limited nature of private equity fund structures, for example. I also wanted to try and take advantage of the network effect in the sense that the great returns that RIT has produced has not only come about over the last 35 years because of the patient approach that they've taken, but the connections that the investment team and Lord Rothschild himself have brought them into contact with deals that they wouldn't otherwise have been able to access. And therefore, they've done some esoteric, interesting things in private equity and private credit markets that have worked out very well. And finally, the asset mix has evolved over time according to how the investment teams see the world and see markets generally. So I wanted to create an investment trust, a permanent capital vehicle, to address the theme that we've been addressing at Web and that I think is one of the great secular investment trends of our time. So I met up with Graham Thomas, who's on this call somewhere, who was at the time the effective chief executive of RIT Capital. And Graham and I hatched a plan to bring Menhaden to the market, which happened in July 2015. Graham was and remains chairman of the investment committee on a non-executive basis. And I'd say we set off probably on the wrong path. Our performance was weak in the first 9 months, partly on account of a whole bunch of venture stuff that we had acquired back to back for shares at the IPO, and which we subsequently sold on the secondary market at a big haircut. And partly because we were a little bit broad, I think, in our investment approach. And so long and the short, we were more than 20% down 9 months in. And we invited a credit investor who you see in front of you, Luciano Swana, ex-Barclays, he'll give you his background in a moment, to join us. And Luciano spent several months looking with Graham and me at the strategy. And the three of us decided that we would become effectively a value investor. So we decided to look at all opportunities through a Venn diagram. And one of those circles is the energy and resource efficiency theme. As described in our prospectus, opportunities or companies which deliver or materially benefit from the more efficient use of resources. The second circle is quality. So we only look at companies, publicly traded or private, which have strong competitive positioning, high entry barriers, which have strong balance sheets, and whose financial performance, with some degree of comfort, we can predict. And the third is value. We like to be able to invest in opportunities at what seems to us demonstrably good value. So we completely revolved the portfolio during that time, kind of beginning at March 2016, so just over 5 years ago. We got out of all the growthy equities and growth companies trading on big multiples and shifted into opportunities which fit that new Venn diagram that we approach. We also got rid of all the venture and growth stuff from the portfolio and built a new portfolio of private positions, which at one time amounted to about 40% of the portfolio, but following a bunch of successful exits during the course of the last 2 years, stands currently at less than 20% of the portfolio. And it's working. We've compounded at around 13% before fees annualized for those 5 years since. I wonder actually if it's worth, Luciano, you introducing yourself and giving your perspective on that transition. And then I will tell our listeners about some of the private positions that we hold, and you could talk about some of the more concentrated public equity positions.
Yeah. So my background, I started in M&A at Kleinwort Benson. I transitioned to their credit trading desk in a unit that was called the Liquids that was started in the early 2000s, basically focusing on infrastructure, real estate, energy, and forestry and agricultural land. 70% of our exposure at the time we were looking at was credit, 30% was equity. After that, I moved to Barclays, where I was managing their Brazil credit trading unit. One of the guys that worked for me in London had set up the fund together with Ben and Graham in 2015. And so he introduced me to the team. And after looking at the portfolio, it looked like, I thought that there were some changes that we could enact in order to have a more resilient portfolio. So that's what we did. As Ben mentioned, we transitioned from a very growth-oriented portfolio towards a more, I would say, more oligopolistic type of companies. Companies that have very high entry barriers, very solid balance sheets, and where we feel very comfortable about the growth prospects in the future. I think another point that I think it's important to mention from the portfolio construction, apart from the 3 Venn diagrams, is like on a macro perspective, we are very worried about inflation in the near future. We think that the current experiment of ultra low rates and negative real rates it's probably going to be with us for a long time. We think that's probably one of the few options that governments have in order to deflate the massive debt bubble, and they expect hopefully to have positive GDP nominal growth and keep taxation as a fixed percentage of that GDP nominal growth and deflate the bubble. So you want to own infrastructure assets and companies that can pass that inflation increase. So that's another important aspect when we think about investing. I think, Ben, you could continue now, and if you want to talk about the privates.
Yeah, so we made the decision that to the extent we invest in anything in private equity or private credit markets, we'll do so in partnership with much larger established firms. So we've, for example, co-invested twice now with the infrastructure team at KKR Private Equity. We've co-invested once with Apollo, which is a leading private equity infrastructure and real estate firm in New York. We've co-invested with a different Apollo, unrelated, called Perfin Apollo in Brazil, in an electricity transmission infrastructure opportunity. We've looked at deals with a whole bunch of these firms, Blackstone, TPG, and have co-invested in a suite of private credit opportunities with TCI, the hedge fund group. The idea being that we're a small team, with a relatively small pool of money, and therefore we want to ride in the best deals alongside the very best players in these markets. And we have the connections to get ourselves into these deals on preferential terms. In fact, we're yet to pay management fees in respect of any of the co-investments we've undertaken with these firms. So the biggest one that remains in the portfolio following a suite of exits during the last 2 years is a business called Xcelio, which is a solar platform. And this is a Spanish headquartered company which specializes in developing and operating solar assets in places in the world where you have lots of sunshine, high power prices, and a good regulatory regime, such that these assets don't rely on state subsidies or other support for their economic viability. So the Xcelio team have focused on Japan, Mexico. They've also been in Spain. They're very prudent, very experienced, very smart guys that have generated fantastic returns in those places, including through the opportunistic sale of these assets to buyers when those opportunities become available. So their entire Japanese portfolio was sold 18 months ago on an implied IRR of more than 40% after 4 years. They sold a big chunk of their Spanish portfolio this year to China Three Gorges Corporation. They know what they're doing. And the thesis there for us was that we were investing in a bank of assets producing low to mid single digit IRRs, sticky inflation-linked long-term revenues. And that was our sort of base case, therein lies the downside protection. And the upside story was around the development of a big new pipeline of assets in these 3 countries. And as it happens, the team have been successful in developing that pipeline and have attracted a major new investor, Brookfield, which is one of the world's largest infrastructure firms, Canadian firm, which has acquired a 50% stake in Xcelio. And as part of that transaction, we cashed out a third of our position on almost a 2 times ROI. So this is the kind of stuff we want to do. It's solid assets with predictable cash flows and potentially some upside in the form of development of new assets or sales and marketing and internationalization, as is the story with Callison, which is the second co-investment we undertook with the KKR team. Callison is the UK's market leader in domestic energy metering. That business, at the time of our investment, was operating about 4 million energy meters in British homes, mostly on 20, in some cases 25-year contracts, inflation-linked, very sticky, predictable revenues. If a homeowner changes utility, the contract to manage the meter remains with Callison. So this is an asset base producing predictably low single-digit returns for the investors. But the upside story was all in KKR's plan to develop sales, marketing, and an internationalization plan for the business, which during the last 3 years has worked out. Callison now runs approximately 12 million meters in the UK, nearly tripled the number of meters it's managing here. They've also got their first contract in Australia for several 100,000 meters. So the internationalization plan is underway. The business is now in the FTSE 250 and is subject to an acquisition, which is just been completed. So that's been a successful story for us. The only other private position still in the portfolio is a commitment alongside Sir Christopher Hone and his foundation and other TCI investors to what is effectively a friends and family credit fund operated by a team within TCI. And they provide short duration mortgage loans to very large developers in the bluest of blue chip locations around the world: New York, central London, central Tokyo, Los Angeles. And these are loans that are big, sort of 500 million to $1 billion, sometimes bigger than that. And the proposition to the borrowers is that TCI moves much quicker than a syndicate of 15 or 20 banks would. The interest rate is typically 10 to 12%. The duration is typically 1.5 to 3 years. And the LTV is never higher than 55 or in some cases 60%. And the fund has delivered a consistent track record at 11% for more than a decade now. So we're in that fund alongside Sir Christopher, who happens to be one of our shareholders, and we don't pay management fees on that, although there is a small carried interest. So these are the kind of things we've done. I'll just mention briefly the 2 exits we've had. We were invested alongside Apollo in a residential real estate portfolio in Berlin, where the proposition was to retrofit those buildings for energy efficiency and quality in order to move the apartments into a higher rental bracket according to the Berlin rental rules. As it happened, the position was acquired quite quickly, within 9 months of our investment, by a much larger real estate player in Germany, and that brought us a 25% return on investment in under a year, and opened the door to an ongoing relationship with Apollo. And the other was an investment with some former colleagues of Luciano's in Brazil through Perfin Apollo, which is a major infrastructure player. And that was an opportunity to invest in some operating and development electricity transmission assets, so pylons. The whole portfolio was listed in an IPO just over a year ago at an implied 4 times return on investment for us, and we decided to cash out entirely at the IPO. So we've had 100% good track record in these private infrastructure, private real estate, private credit co-investments that we've been undertaking, and we're looking for more of them. What we won't do is the stuff that I personally find very seductive, which Luciano hates, which are the technology, venture, early stage or growth technology opportunities that we see a lot of. We have a deluge every week of exciting stuff to look at, but we're not investing in that kind of binary outcome, earlier stage stuff at all through Menhaden. To the extent we do any of that, we do it PA. So that's a major departure from our original intention when we launched Menhaden in 2015. Luciano mentioned we run quite a concentrated portfolio. So the aim was always to hold around 15 positions, each one being meaningful to us. Therefore, I wonder if, Luciano, before we jump into questions, whether you might want to talk about Alphabet, which represents more than 20% of the portfolio now, a little bit more than it did last week,
Sure.
Charter, and some of the others.
Sure. I think, as Ben mentioned, the portfolio is very concentrated, and we tend to have very large positions in the companies that we have very high conviction. In the case of Alphabet, for us, it's probably one of the best businesses in the world. Just looking at their main businesses, the search, the YouTube, and the other advert business, we get to a very decent above 10% IRR. And the interesting thing in the case of Alphabet is that we see a lot of optionality with other businesses, like probably all of you have heard about Waymo and their AI technology that after Alphabet acquired DeepMind. So we see huge applications for their technology in the fields of education, call centers, healthcare, and that's something that we see as kind of an extra, right? It's similar in the case of, we all know, so Microsoft, and I think not many people expected the big deal that Microsoft had with the US Defense Department and the Army, and with the HoloLens deal, right? Which was a very sizable deal, more than $20 billion. When we looked at the portfolio construction, one of the things that we try to avoid is always like asymmetric risk. We try to make sure that we have very limited downside. And one of the things that we think about is all these companies that we own is like time is in our favor, right? So the multiple, the growth that these companies are experiencing will give us a very decent buffer in case things go wrong in the near future, but in the long term, growth basically protects us. If you look at the rest of the portfolio, like apart from Alphabet, you'll see Charter is a similar story, very predictable cash flows. It's practically an oligopolistic business. It has very little competition in 70% of in the areas where they are present. Broadband nowadays is an essential public infrastructure, right? It's in the same level of water and electricity. So the interesting thing with Charter, for instance, is the fact that it's a leveraged public buyout. They have a growing business. They are adding new clients every year. The EBITDA is growing at a mid-single digits kind of level, and their free cash flow is growing above 10%, and they keep that free cash flow levered, and with a net debt to EBITDA of approximately between 4 and 4.5 times, they keep buying back. So it's a very traditional leverage buyout strategy, and where we think we're going to get returns close to 13-14% maybe. The rest of the portfolio, we could mention the railways. I think it's a very interesting case. We own Canadian Pacific and Canadian National. Both are regional monopolies again, and with very high pricing power. That ties up with what we mentioned about our macro view, that if you want to own companies that can pass that inflation to customers. And I think a perfect example is what happened in early 2020, when just after the beginning of the pandemic, volumes went down by up to 30-40% in some cases in the first quarter. And the railways, they managed to keep revenues almost stable, which means that they had a lot of pricing power. They increased prices. So you'll see this is like the portfolio is very defensible. It's very high quality, all high quality companies with very solid balance sheets. The only company that you can have, you have a bit of leverage is Charter, but at the same time, it has very predictable cash flows. So we are very comfortable with the portfolio, and we envisage returns that are around 10 to 12% at the moment. I think if there's any specific question about the portfolio, probably.
I think that probably the best way to do this is through the Q&A. There is a Q&A function in which people can ask questions, and I think Matthew was going to chair this. Yeah,
so just remind those who missed the beginning, if there's a Q&A button at the bottom, please submit your questions through that. We've got a few here. You mentioned your current expectations for rising inflation and low interest rates. What effects do you see these having on the portfolio over the long run, and how are you protected?
So one of the first effects is that we already experienced is the fact that you had multiple expansion, right, across the board. I mean, it's the first thing you see is like rates are gravity, and there's very little gravity, and asset prices are going up. What we are trying to do is like owning companies that regardless of the future scenario, obviously if you end up like hyperinflation, then it's a different discussion. But we are not macro people. We do bottom up, and we think that the companies that we own are in a very good position to defend themselves if moderate inflation happens.
Brilliant, thank you. What opportunities are you seeing in the private deals space, and has anything particularly changed in that arena over the last few years?
I mean, we get a deluge of venture opportunities and growth stuff. So companies developing exciting new technology in the fields of renewable energy, electrified transport, battery technology, a lot of food tech, businesses which are developing ways to manufacture alternative proteins, this kind of stuff. We aren't touching any of that, albeit it's intellectually stimulating and it's useful for us to have a handle on the disruptions that are occurring in the world around us and the impacts that they will have in our portfolio. We also get a deluge of renewable energy project development, wind farms in Ireland, solar assets in the region, equity or debt those built. We have enough renewable exposure through Xcelio. We really know that team. We rate them very highly. And so we're sticking with that. We're not looking at new renewables capacity ourselves in the portfolio. The things we're trying to find are businesses which have some kind of barriers to entry, which underpins their competitive positioning. So for example, water infrastructure, or the infrastructure underlying waste collection, sorting, recycling, electricity transmission. This is the kind of stuff that can't easily be replicated. It's the kind of charter effect. We like Charter's massive installed broadband base. To the extent we can find things that look like that in private markets, then we're excited. We're seeing a lot of stuff in recent weeks. It seems like activity is picking up, and with the emergence of people from their caves as lockdown is lifted, we're spending time now with leading private equity, private credit investors, catching up, hearing what they're doing, and ultimately trying to present to them that we're useful partners to have, and that we can add value. I think we were helpful to the Xcelio team. We organized a roadshow for them in India. We organized a whole industrial fact-finding trip for them in the Middle East. I've become quite close with the CEO of Xcelio, and I think we've convinced KKR that we're useful people to have in a deal. So the effort on our part is really about building relationships with those who are doing the deals. And our focus is on private opportunities with solid assets, cash flows, and high entry barriers. Not easy to find.
Brilliant, thank you, Ben. Just following on from that, and how do you see the private equity proportion of the portfolio changing over time in terms of overall allocation?
And we talked about this in our investment committee yesterday. I mean, I don't see the portfolio being invested more than 40% in private equity, private credit, which is roughly where it was at towards the end of 2019, when the exits started occurring, the Brazilian exit, the partial exit of Xcelio, an exit from our Berlin residential real estate play. So I would have thought kind of a third to 40% would be the uppermost limit. At the moment, we're significantly less than 20% invested in private opportunities. And those are solid assets that are producing cash flows for the investors. That's why the discount, I know I'm changing the subject, but that's why the discount at which the share price is trading against the net asset value right now is absurd, because you're effectively buying Alphabet, Charter, the North American railroads, and a bunch of other blue chip global equities, and a small proportion of blue chip private equity co-invests at what is effectively a 30% discount.
I would just add to what Ben said, that there's another aspect to look at the private deals is also quality, right? It's very difficult to find companies that have similar quality to the listed ones that we own. Private equity, sometimes they get to their desired IRRs by increasing leverage, but having a higher IRR doesn't make it a better deal. It makes it a riskier deal, right? So we are very disciplined, and all the private deals that we invested, we had some decent downside protection, and we're going to continue being very disciplined.
Brilliant, thank you. Just following on from your comments on the discount, we got a question in the presentation saying that you will continue to assess all options available regarding the discount. If you are able, would you kindly elaborate on what those options are and which of them you'd expect to be the most effective?
Luciano, why don't you take this one?
This is something that I think, since I remember when I joined in March 2016, and that the debate started then, where the discount was approximately 30%, and one of the things that people mentioned was, should we buy back, right, for instance, and the conclusion after speaking to many people in the closed-end investment trust industry was that it would be a short-term gain for long-term pain, right? It would be, we would increase the percentage of private deals, which at the time people were not comfortable with because some of them were not performing, and would make us smaller, and at the same time would make us less liquid. So we took the decision since then to basically try to focus on performance, and if performance is being delivered, and size will help us. The average discount for closed-ended investment trusts in the UK trading below 200 million pounds of market cap is approximately 15%, or at least it was around a year ago when we looked at it for the last time. So the discount is something that it's not easy to get rid of, and we think that focusing on performance and with a very good quality portfolios Ben mentioned is the right approach. One of the things that we think that will help is increasing liquidity. When I joined in March 2016, the bid offer was 50p, 55p, which effectively precluded any institutional investor from taking a position if they're going to show a loss of 10% the day after they make the purchase. Right now, the bid offer is approximately 3%. It was 2p, 2% even, but somehow they increase it to 3%. And liquidity is increasing. The size of the trust has increased. We also think that costs were an issue. The total cost ratio in March 2016 was close to 3%. Now it's probably slightly lower than 2%, and so that's what we think is what we should do, is focusing on performance and making the trust bigger.
Brilliant, thank you. Just one question on Charter Communications and about the size of the position in the portfolio. Could you elaborate on your outlook and also your assessment of Charter's credit rating?
Yeah, the credit rating, I think you have to think that the rating agencies have a very formulaic way of looking at things. So they look at Charter, the net debt to EBITDA is 4.5 times, therefore it's like it's a high yield type of company for them. But sometimes the value of the company can be in the credit, sometimes the value can be in the equity, right? We don't view any value at the moment with in credit. If inflation increases, any long-dated bond will dramatically suffer. So in the case of Charter, the interesting thing is that the size of it is a very large position for us, and we are very happy with it for the following reasons. It's very predictable. They are the cheapest provider of broadband in out of all the major players, and they will keep gaining market share, and by keep gaining market share, they will benefit from their massive economies of scale. And it's a very simple business, but in terms of future returns, it's very predictable. So it's definitely, I wouldn't look at the credit rating in order to take a decision in terms of the size of the company.
Can I jump in, Matthew, and answer two questions I've seen in the chat? So the first is the cash level. At the end of March, we had 2% of the portfolio in cash. But those of you who have BDIs and are following the portfolio will have noticed that the Callison transaction was completed during the course of April. That's publicly available information. And another question is, how much of the PLC is in the hands of the home team? And the answer to that is a little more than a quarter of the shares, a little more than 25% of the shares in the PLC are in the hands of me, members of my family and my family's investment group, Luciano and members of his family, Graham, Teddy, who's in our team, and also members of the board, so Ian Cheshire and other members of the board also hold shares. So just over a quarter. The rest is free float.
Brilliant, thank you. You mentioned your exposure to semiconductors in the slide deck, a rather important topic at the moment. What is your long-term view on that space, and what are the key drivers?
Ben, should I? We think that the semiconductors are one of the most important businesses in terms of resource efficiency. People know about Moore's law, but not many people know about Comey's law. Effectively, Comey's law tells you that the resource efficiency doubles every year and a half of semiconductors. In terms of, we like them very much, but the only issue we see is valuation. We bought them. It was one of Teddy, our analyst, was very keen on them, and we entered them at the end of last year, and effectively some of the positions almost doubled. Right now, we think that they are probably on the expensive side, but we are monitoring them, and if there's a pullback, we probably would add.
Brilliant, thank you. How do ESG considerations play a part in your decision making, and how do you approach the reporting of your impact?
So we are not an impact fund or an ESG fund or an ethical fund. We are a thematic fund with a particular focus on the theme of energy and resource efficiency. So we were set up to focus on that secular trend that's taking place across industrial sectors in the world economy. That being said, we are deeply mindful of environmental, social, and governance factors in our investment decision making. Not just because that's the right thing to do in today's world, and something that matters to us as a team and individually, but also because we think that these factors are critical to the financial performance of the businesses in which we're investing. We just wouldn't want to invest in a business that's having negative social impacts in the world. For example, we think that in an age of social media and increased visibility, big companies just can't get away with bad behavior anymore. You can't be trashing fresh water in one part of the world whilst presenting your shiny face through advertisements in your core market territories. It just doesn't work anymore. Companies in today's world have to behave well from an environmental, social, and governance perspective. Otherwise, they lose market share. They struggle to retain or even to attract talented staff. They end up suffering a higher cost of capital as investors desert them, and so on. So we think that these things really matter. We think that they're deeply material to the financial performance of the businesses in which we're investing. And so we have an environmental, social, and governance policy in respect of our investment decision making, and we lay out the output of that in an impact report that forms the centerpiece of our annual report, which can be found on our website. But we are not an ethical fund or an ESG fund.
Brilliant, thank you, Ben. What's the level of turnover and overall portfolio activity in Menhaden?
I think in terms of the privates, obviously Ben mentioned that we exited some of them, so we had to deploy, and therefore we invested in companies that we feel comfortable. But we tend to have our 3 to 5 year view on each position, so we don't tend to make a lot of changes. Sometimes we just make we rebalance the portfolio after quarter earnings, and then we take a view, but it's more like an evolution rather than big changes.
And what would you consider to be the biggest risks to the portfolio today, and how are you looking to mitigate these?
I think probably if you have like I think that if liquidity continues, the current monetary policy continues, there's a big chance of like a bubble happening in markets. I think that we can still defend the valuation of the ones that we own, but we see a lot of froth in other parts of markets. I think that everybody has heard about cryptocurrencies and SPACs, and I would say that there are some companies that the valuation is very difficult to justify. In our cases, I think the portfolio is fairly priced at the moment.
Brilliant. And where does your strategy of investing in companies benefiting from resource efficiency leave you with regards to renewable energy opportunities?
Well, thematically, renewables fit perfectly. I mean, it's the ultimate circular economic model, is using the weather to generate our electricity. So from a thematic perspective, it fits. I think the issue we have with renewables is the fact that you're selling into a commoditized marketplace with a pricing structure in which power is getting cheaper every single year. So cheap solar is great news for ourselves and for the world. And solar is now out competing fossil fuels and nuclear. That's all great news. From an investment perspective, the risk is that cheap solar doesn't just strand coal and gas and nuclear, but that cheap solar strands earlier solar. So if you've got a bunch of 2016 or 17 vintage solar assets, it may become economically viable to build a bunch of new assets in 2021 or 2, and simply and your earlier assets lose their customers, especially if they're selling into the spot market. It just doesn't work. Luciano, do you want to say more on that?
I would just add that I think that sometimes people make a mistake in looking at the renewable. They tend to look at the renewable space or resource efficiency or ESG on the environmental side of things. It's kind of a very binary thing, right? They either look at a company's either green or not. And I think the problem is that it's a lot more complex. There's all its different shades of gray. In the case of a wind farm, for instance, 1 megawatt of a 1 megawatt turbine uses 9 tons of plastic, dozens of tons of cement and steel. So all those they are a problem. So it's not so simple. And I think what we try to do, we try to take the long view, which we think that all the companies that are going to survive long term, they have to look at the resource efficiency and emissions, right? And I think the perfect example is companies that like Alphabet that use 100% of their energy from renewables, but also not only that, they try to add marginally to efficiency gains in their data centers using their own proprietary AI technology, right? So I think that's the right way to look at things.
Brilliant. Well, I think we've exhausted the questions. So if there are no other questions from participants, I'd just like to thank you all for attending. Ben and Luciano, thank you so much for your presentation and the Q&A session. So if there are no other questions, then I think we'll leave it here, and I'll leave you to say your farewells, Ben and Luciano.
Well, thank you very much again, Matt, for organising it. Thank you everyone for attending. We're very grateful. If you are minded to buy stock in the company, then contact James Glass at Numis.